Good afternoon. We'll start the call in a minute's time. Yeah. Good afternoon, everyone. Welcome to ASK Investment Managers quarterly update call on domestic resurgent portfolio. My name is Prashant. I'll be your host for today's call. We have today with us Kuldeep Gangwar, fund manager. Kuldeep has more than 18 years of experience, which includes 15 years of experience in equity markets. He's got more than a decade of experience on sell side of research equity. Kuldeep's main domain expertise is in consumer sector, FMCG and retail. Prior to joining ASK, Kuldeep was associated with HSBC Securities and Capital Markets India Private Limited. He's worked with Tata Motors for more than 3 years. Kuldeep has an MBA in finance from IIT Mumbai, and he's a Bachelor of Engineering in Electronics from IIT Roorkee. Kuldeep is a CFA charter holder, and I welcome Kuldeep to the call. Kuldeep, please take us through your views on the market and update on the call. And we'll do a Q&A at the end of the session. I would request all the participants to please type in your questions in the Q&A box. Over to you, Kuldeep.
Thanks a lot, and good afternoon, everyone. I hope my slides are visible to you. So when we think about the market outlook, I do believe that you are listening to various news channels, you are reading various newspapers, and there are multiple forums telling you that there's something wrong with the world. And negative news, if we think across, then it's inflation, 40 years high, economies progressing toward recession, war in Europe, record high global debt. We are talking about, say, weather conditions are not conducive. Like if you're tracking, say, weather report in India, we are talking about, say, we may have a warmer weather, deficit monsoon, which is not a good news for Indian crop, and so on. And it's coming along with that deteriorating relationship with the two global measures. So it's quite negatives around going on. At the same time, when we think about, say, global economies, then probably India is a bright spot, not for the current year, probably years to come. And India would be among the fastest growing global economies. So even in the tough time, when we are talking about slowdown and recession, which will be largely led by, say, Western economies or say developed market, India may still have, say, high single-digit real GDP growth, and it may continue for medium to long term. So obviously there is a lot of negative around, but probably we are at the right place where the things could be happening. If we think about, say, world inflation, we know that it's running high, but at the same time, our understanding is that peak has passed, and it's a response in terms of Fed increasing the rate, RBI increasing the rate. Probably we are coming close to the peak. Like Fed has already increased close to 4.5% interest rate in last 11 months. And we may have another 50 basis point or so, but it should stop over there. And after that, probably 6 months or 9 months down the line, a moderation should start. So we are coming close to the worst of this interest rate cycle up move. If you look CY22, it can be split in two halves. First was when the commodity prices were rising, crude oil price moved to close to $125 plus, and whether it's a metals or any other, say, commodity, we were thinking about or looking at moving upward. In second half, the picture get reversed, that the crude has come down and most of the other metal prices or, say, palm oil, wheat, rice, everything has come down from its peak. It's only suggesting that the worst is behind from the inflationary upward movement perspective, and it's just wait and watch from where the picture should look better in time to come. This is something I already highlighted, that last year beginning we had close to $128 peak for the crude oil, which had negative implication for our own current account deficit because we are among the largest importer of the crude. But good news is that it's coming down and stabilizing close to $80 or so, and which is good for the overall macro perspective in India. If we think about, say, freight index, which is also coming down, it should provide some relief on the input cost if the freight is coming down. Food prices have also peaked out and moving downward. So net, while there are many negatives which are being talked about in terms of high inflation, geopolitical situation, high interest rate, but probably the worst is behind and things should start moderating, say, in time to come. In that backdrop, if we look at the domestic economy, so we have reasonably good forex reserve. We have relatively, say, better macro situation, as I say so, because despite crude running close to $80 or has seen the peak of close to $120 or so per barrel, current account deficit should be more close to 3% of the GDP now, vis-a-vis, say, 3.4% envisaged sometime back. And FY24, it should have a further downward tick. So global macro having obviously adverse meaning for our own economy, but probably the thing should improve in time to come. When we think about, say, domestic activities, GST is running at good pace, like close to 1.4 lakh crore, and our figure had been 12 months consecutive. And when we think about, say, credit growth, it also picked up in recent times. So it just shows that the economic activity on ground is good. So overall, if I look at, like, we do believe that India is having its own tailwind coming from, say, China +1, and now we can add to the same the Europe +1 as well, given the situation evolving in the Western Europe. PLI is driving the momentum. Capacity utilization has come to the level where the incremental capex will be required, and it looked like that the non-food credit growth should also be remain robust. So in this backdrop, if we think about domestic resurgence portfolio, First, I will like to give a backdrop, like what this particular strategy is all about. So DRP is focused on domestic growth opportunities, as India is likely to be one of the fastest growing major economy in medium to long term. And private consumption account for about 60% of the GDP, and it is likely to remain a key anchor for India growth story. In last couple of years, we have seen multiple reforms which have taken place and which should help us in coming years. If we look the major themes, so in case of DRP, if you look the portfolio psychography, it's quite clear that it's overweight India and it's overweight consumption. Like consumption is almost 60% of the GDP and almost 38% portfolio DRP source from that area. When I say consumption, it includes beverages, consumer durable, retail, discretionary, staples, everything put together. So we are overweight in that particular segment. Financial is another theme, like we are going to observe, or in effect, we are observing that formalization of economy, which is leading to higher penetration of the banking products. Within banking sector, private banks are gaining market share, and this shift is happening from less efficient to the better run private banks or NBFC. And we do believe it should continue. And that's the reason financial are big backbone of any economy, and we have a decent exposure coming from the financial side. So almost 30% of the portfolio is coming from the financials. As we have seen in last 3 years, there had been increased focus on the manufacturing side. So government wants that manufacturing contribution to increase from close to 14% of GDP to almost 20 to 25% in medium to long term. And we are sourcing close to 12 to 13% portfolio weight from those areas. It's a relatively overweight position when we compare from the benchmark. Technology, platform, software services, these are going to be, say, anchor for upcoming, say, growth story. And whether we think about, say, platform services like whether it's retail or telecom, these things are going to be a driver for faster digitization of our own economy. So we are having decent exposure in that area as well. And some part of the portfolio is coming from, say, gas utilities and specialty chemical. So financial, consumption, and manufacturing, these are the 3 main areas for the DRP. If we look the psychographic, that in FY23 and FY24, we expect close to 25% plus earning growth. And it's not about these 2 years. If we look the history in last 5 years as well, that the portfolio companies would have delivered more than 25% PBT growth or say PAT growth. And this is our position, like high quality, high growth. So it's being delivered in past, and we do believe it should continue. Like we are focused in areas where the growth will be ahead of, say, nominal GDP growth, and our company should benefit from the tailwinds. And this is something happening despite set of macro environment. Like even in Q3 FY23, say operating profit growth for the DRP was close to 20% plus, vis-a-vis Nifty, it was say 12%. If we look, say, forward FY23, FY24 earnings, as I mentioned, that EPS growth expected should be significantly higher what we expect for the broader market overall. So we do believe as long as the earning growth is coming, it's a great position to be in, because sooner or later, the higher earning growth should also translate into a decent stock returns. And if we look the performance in last, say, 4 years, it again can be split in 2 parts. So DRP was launched in 2018 calendar year. And if we look 3 calendar year, 2019, 20, 21 combined, 3-year CAGR performance for DRP was close to 21%. Vis-a-vis, say, BSE 500 close to 18% and Nifty close to 17%. In 2022, DRP underperformed. The portfolio return was close to 4% negative. Vis-a-vis BSE 500, it was 3%. We do believe there were many factors which helped benchmark to do better. And there was certain stock which did not do well in 2022, but has started coming back. It is already quite visible in CY23. when DRP is down by 3%, vis-a-vis say benchmark would have been down by 6%. So net, we do believe that our portfolio companies are delivering a strong earning growth as we speak and should continue to deliver in time to come as well. And we know that there is no linear relationship between earning growth and stock return, but ultimately they converge. So if earning growth has not translated in recent past in the stock return, probably it should happen in time to come. And we continue to maintain our positioning of high quality, high growth, and there is no deviation to that particular part. I will stop over here and happy to have any question which you might be having.
Yes, Kuldeep. I would request the participants also to post your questions. We have some questions coming in, Kuldeep, and then let me start with the first question. The last 1 year, the markets have been very volatile, and the portfolio has been holding on. And then in last 3 months, we have seen a very sharp bounce back in the portfolio, especially in the last 1 month. The portfolio performance has been positive 1.4% as against minus 2.9% of the BSE 500. What has worked well in the portfolio?
So first of all, as I mentioned, that the domestic resurgence portfolio is primarily focused on the domestic economy side. So if we say India is going to be among the fastest growing major economies, probably DRP is having the best of India economy available, because more than 90% portfolio is coming from say, domestic opportunities only. As I mentioned, that there are some certain times when things do not work out from stock return perspective. It has more to do with say perception that the macro is not doing good, or say short-term underperformance of companies, etc. But as and when that operating performance start coming back, say stock do respond. I will just give you 1 or 2 examples. So Radico Khaitan did experience close to 18% correction in CY22 because they were doing capex which had implication in terms of higher depreciation. They were going through a rough patch because commodity prices were up and so on. But probably they were putting everything in right place, like that capex is going to help them in terms of say premiumization, backward integration, and that's the reason we do believe that that company can deliver or double its earnings in next 2 years. And this is something has happened, like in last couple of months, that stock has again come back. So a journey from say 18% correction in CY22, and again the reversal in fortune. So sometimes best of engines also need the cooling off period, and that is something has happened in last year. Again, another example may be Gujarat Gas, like last year, say spot LNG prices were up, input cost prices went up, and alternative like propane prices came down. So it had some implication for volume growth, because Morbi, which sourced the say gas from Gujarat Gas, they had the alternative to move to relatively cheaper prices in terms of propane. But it's again reversing now. And it's a structural trend which we are more interested in, like company can deliver double-digit volume growth and can maintain healthy margin. So CY22, I would say, was a blip in the overall story. And probably the things are again coming back. So these are a couple of examples that CY22, they took the breather and now probably they are running at the course again.
Yeah. Thank you, Kuldeep. Kuldeep, the budget has been announced and there is a lot of thrust on the capex as well as the consumption. How is the portfolio positioned to take advantage of this?
Sure. So if you look portfolio psychographic, in budget, it's announced that the capex will be almost 33% higher. And that's the reason we want to have higher exposure in those areas which benefit out of the increased capex. So if you look, infrastructure and engineering is having almost 12.6% weight, vis-a-vis benchmark 9%. And it includes the company like, say, APL Apollo over there, and some of the companies like Polycab on the KI Industries, as well as our exposure toward the cement. These are the companies which should benefit from the tailwinds available in those areas. Just to give example, like Polycab, almost 90% portfolio come from cable and wire. It should benefit from pickup in the residential capex as well as the industrial capex. For KAI, almost 100% is coming from cable and wire. And if the overall capex is picking up, this is the company which should benefit out of it. As you would be going through that, many new airports are coming, metros are taking place, and so on. So if it's happening, then APL Apollo benefit out of it. If the cement is going to residential capex or roads or otherwise, then probably something like Dalmia Bharat benefit out of it. So we have decent exposure towards those areas which benefit from the higher capex in the country.
Yeah, thank you, Kuldeep. And that there is a follow-up question to this, that you have both KEI and Polycab in your portfolio, and both are in cables and wires. So what is the, I mean, how do you want to play it? I mean, same sector and then two different stocks.
So it's more about like we want to have sizable exposure in those areas. Polycab is number 1 and KI is number 2. In case of KI, valuation were relatively more attractive, and that's the reason we decided to go for it. And that's all about it. Like Polycab, they are exploring, say, FMEG part as well. So it's going to be mix of, say, this industrial, residential capex along with consumer durable part. But in case of KI, it's a pure play on, say, capex as we speak. So it's all about combination of the largest of the companies available in that area, and followed by number 2, which is available at relatively lower valuations.
Yeah, I have a next question for you, Kuldeep, that continuing with the budget, there is an announcement on taxation of the life insurance. How would it impact the life insurance companies going forward? And you have SBI Life in your portfolio. View on that also.
So we have SBI Life in our portfolio. So obviously, announcement, we know that premium more than 5 lakh in the non-par segment is going to be taxable. But we will have to look case by case basis. So in case of SBI Life, only 2% of the APE, which is the annual premium equivalence, is coming from a premium having more than 5 lakh. So very small impact on the overall, say, top line for the SBI Life. And valuation has also become quite reasonable. As far as life insurance, say, as a sector is being concerned, we do believe there are good tailwind available in that area. We have under penetration as well as lower per capita consumption of, say, insurance products. And there is a shift from, say, PSU to private, or say like LIC to other place is also happening. And we are quite confident that growth may continue to sustain. And we are going for a player which is sizable, at the same time least impacted from the changes in the regulation over there.
Yeah, thank you, Kuldeep. The next question is, did we see any negative surprises in the portfolio companies with regard to business and stock performance in the recent past as against our expectations?
So Dixon was among those names, like where the performance was below expectation. They started the FY23 with the close to 16,000 crore revenue guidance, and it kept on coming down. There may be genuine reason for the same as well, like two segments did not work well. One was a consumer electric, where the revenue declined by 38% in Q3. Lighting was another segment where the revenue declined by 38%. Mobile segment also did not work in line with expectation. We do believe whenever things are changing dramatically, like Dixon was Dixon is the poster boy of India's PLI story, and they have delivered in past and probably should continue to do in future as well. But when major shifts are happening, sometimes it's not a straight line. Like there will be always some plus and minuses happening at any given point of time. So revenue growth, which earlier envisaged more than 50%, probably it will come down to 17% now. But from operating margin perspective, there is a better delivery. So it's a mixed bag. And operating profit growth is more likely to 30% plus, more in line with the 5-year trend we have seen. So net, I would say that there was significantly higher expectation. There was some shortfall in that particular area. And that's the reason that stock price came down in last 3 months, particularly. Otherwise, it's a structural story, the way we think about it.
So thanks, Kuldeep. The next question is that you are holding Patanjali in the portfolio. How do you see this business spanning out, and on your view on the management also?
Sure. So first, we should look the nature of the business. Like Patanjali Ayurveda, which is the current promoter, they acquired this company in LCLT in December 19. This company used to be edible oil company, like 90% revenue, or 97% revenue, and 90% operating profit coming from those areas. It's changing now. So narrative is good, like non-edible oil segment will be having less than 50% contribution in FY24. And in next 5 years, the non-edible oil operating profit contribution will come down to 25%. It helps that high margin FMCG business gaining more traction, bringing more visibility, and also providing acceleration to the overall earnings. So one, the narrative part, like it's moving from commodity to branded. Second is like the growth should also pick up because FMCG is relatively faster growing segment with higher margin. So earning growth trajectory should be also 20% plus CAGR if we think about for next 3 to 5 year perspective. Third part is what the management has done or say promoters have done in last 1.5 years. They transferred the food business from unlisted entity to say listed entity. So more than 5,000 crore worth of revenue and close to 750 crore worth of EBITDA was transferred to the listed entity for almost 750 crore only. If it would have been a standalone entity, it was worth close to 25 to 30,000 crore. So it was a shift of value or value transfer from unlisted to listed company. It shows the intention as well. If we think about valuation, valuation would be in the range of 20 to 25 P for next FY24 if we think about it. So almost 50% discount. So it's having combination of narrative, it's having prospects of higher earning growth delivery. It's having a reflection that how the new promoters are thinking about minority shareholders. They are transferring value from unlisted to say listed entity, and it's available at significant discount to vis-a-vis say listed peers. So this combination make the Patanjali attractive proposition from say value creation perspective. As far as the management is being concerned, so current CEO came from with very credible background, like he has worked in Britannia, ITC, Reliance, and if you just go through his history, he's very renowned speaker on various platforms. So probably the business is in right hand and moving in a right direction.
Yeah, thanks, Kuldeep. The next question is on the valuations. We have some stocks where like Bajaj Finance, Bajaj Finserv, there is a general tendency to think that these are overvalued stocks or expensive stocks. Your view on that?
So the way we think about it, like we may have 5,000 crore companies, listed companies. If we apply different filters and think about our own universe, actually we have universe of 200 plus stock. And when we start putting the filters like earning growth more than 20%, return on capital employed more than 25%, we have less than 100 stocks to choose from. So there are very few companies who have the track record of delivering, and where we have a confidence level across various parameters, whether it's a size of opportunity or execution track record. There are very few options available. Okay, and sometimes we do believe that next year earning and the P multiple is the right metric. Probably it has not worked. If you look at the last 5-year or 10-year history, it's all about sustainability of earnings and how long it would be the case. So for Bajaj Finance, we believe the earning growth may remain 25% plus for next 5 years. And if we look, say, options available in that area, hardly anybody come close to that number. Valuations have also come down in last one and a half year because the company has delivered earnings, but the stock price has come down. So as I mentioned earlier, that earning growth and stock returns sometimes do not go hand in hand. Sometimes earning do come early and stock returns follow. And if the stock has corrected, this high likelihood that future earning growth will translate into the decent stock return. So the point I was trying to highlight that if we scan the overall opportunities available, there are very few companies who are in the area where the growth will be happening, who have right to win, strong track record, and Bajaj Finance is one among them. And if you look around, the quality companies, growth companies have always command premium. Always the question is how much. And if we think about, say, 5-year perspective, if the company is delivering close to 25% earning growth, we do believe that it will continue to command a decent premium in terms of the valuation with say other options available in that area. And a reasonable part of that earning growth should translate into the stock return as well.
Thank you, Kuldeep. This is too early to ask you, but a lot of people have started talking about the monsoons, how it will span out. And also there is a talk about El Nino, which has happened, the low depression, which happened some years back. And there is a scare that that kind of event can happen. So your views on how would it impact on the consumption?
So if you look, El Nino, it suggests that there is possibility that weather can be warmer, monsoon can be deficient. And if we think about agri, generally expectation is 3 to 4% growth year on year. But in the times when the El Nino happen, it is muted number, like flat to marginally negative. Depends the kind of crisis the commodities will be having. We have seen that in last 10 years, there had been 3 instances of El Nino. It did not have major material negative impact on the inflation part. It did impact the farm output, so which is not very good news for the rural consumption perspective. But it's still February or early March. We should wait out for another month or two to have more clarity how it will be panning out. So obviously, if it's a case, it can have some negative, but at the same time, if I think about consumer companies' perspective, most of our portfolio company is having significant urban exposure, whether it's a Titan or say Varun Beverages, Redigo Khetan, they should be relatively resilient even in the current say forecast what we are discussing at the current juncture. So we don't have typical FMCG exposure which should have negative implication if the farm output or say rural income is on the lower side. So, but I would say still couple of months should be passed before we can pass any judgment, because in past as well there had been 6 incidences when it was expected that El Nino will be happening, but only 3 out of the 6 actually it had been the case.
Thank you, Kuldeep. You are holding Berger Paints in the portfolio, and that particular stock has been down. So your thoughts on that?
So if you look, Berger Paint is the number 2 player, and if we think about say earning delivery, it's one of the most consistent performer. So if we look whether 1 year, 2 year, 3 year or longer term, the earning growth had been quite resilient. It's all about that the currently market is more worried about say upcoming competition and so on. So we have tried to put a number to that competition as well. Like even if it materializes, competition is successful, able to gain say 15% market share, it only amount to 1 to 2% say lower growth for incumbents in the paint segment. And these companies are explorer, like they keep on looking for new avenues of the growth to compensate for anything which they might be missing out. So these companies, whether it's a Baja Paint, Asian Paint, they are looking for construction chemical, waterproofing, which is going to be relatively faster growing area and a big opportunity. So my view is that if we lose out 1.5% because of the new competition in coming years, probably these companies would be able to come out with the new sources of revenue growth or earning growth. Because market is generally driven by the perception and always concerned about uncertainty. And it will be only addressed when the event actually materializes. So a year down the line, when Grasim will be having its own launch, then we will be coming to know that how the market respond, how much success they are having. If we go by say last 50 years, it's very difficult to penetrate in the paint sector because of the model on which it works. It does require tinting machine, it does require direct delivery to dealers and so on. So just putting capex is not enough. It has to be perfected on various other lines. But at the same time, because it's still uncertainty around, that's the reason some de-rating has happened despite the earning and delivery remaining strong.
So Kuldeep, the next question is it not the right time to reduce the weight on consumption? Since constant rate hikes will impact the consumption sector, mostly the consumer durables and the discretionary.
So while the consumption weight look high, like 38% over there, we should get into say different component of the same. And this consumer durable is nothing but polycab and KI over there, which is having significant exposure towards the industrial part of it. Okay, and that's the reason they represent both the opportunities available. So whether manufacturing or the capex as well as consumption. Second, if you look around in the current scheme of things, the options which we are having, exports have taken a beating based over whatever happening globally, like geopolitical situation. So whether it's IT or chemical, there are uncertainties in multiple areas. When we think about say structural opportunities available to us within our country, consumption is one big piece, and it's all the segments we are trying to play, both staple as well as discretionary. When we say we have higher income, probably discretionary should benefit, whether it's alcoholic beverages, soft drinks, or say lifestyle changes or jewelry, everything should benefit out of it. So consumption is providing defense as well as ability to participate in the domestic growth opportunity. Is the one area where the compounding will be happening, and we are present more in the discretionary side of it, where the earning growth will be a lot more superior. That's the reason we are a lot more confident about the consumption exposure which we are having in the DRP.
Thanks, Kuldeep. The next question is you're holding Reliance Industries, and recently you have added also Bharti Airtel. How do you want? Both are in telecom as a space. So how do you want to differentiate and how it benefits the portfolio?
So telecom is a sector which had its own journey. Like in last 10 years, it has gone through the consolidation part cycle. And probably we are coming to the verge from where, say, earning growth should accelerate, free cash flow should increase. This sector also helped in digitization. And when we think about our next 10-year journey, it's going to be anchor of that particular aspiration. Bharti is pure play on the telecom side. When we think about Reliance, it's having 3 segments available. Telecom is one part of it. Another is, say, organized retail. Organized retail is close to $900 billion approach. Organized retail is coming in an area where the growth will be again faster. So if we think about our own GDP, retail is 30% of the GDP, almost $900 billion. Organized retail is 10% of it. That means close to $90 billion. And organized retail can grow at almost double the pace of the underlying retail growth. So we expect close to 20% compounding in that particular area. So Reliance is present in 2 areas where the growth will be a lot more superior, whether it's the organized retail part or say telecom part. And third is they are having oil and gas business, which is more of a cash cow for this company. So they have best of many worlds. It had been introduced earlier, and later on we also introduced the Bharti when we became a bit more confident about the prospect of the sector.
Thank you, Kuldeep. One last question. You've seen the threat of recession. There's a talk of recession in both Europe and US, and IT sector might get impacted. And you have Infosys in your portfolio. How do you see that spanning out?
So, first of all, if we think about Infosys, despite those recession talks or slowdown discussion which we come across, we still believe that this can still deliver double-digit growth even in FY24. It's among the best exposure available in IT domain. Having said that, we are having significant underweight position as far as software services is being concerned. So we have only 3.5% exposure in that area, vis-a-vis say benchmark would be having close to 11%.
Thank you, Kuldeep. So there are no more questions. Thank you everyone for participating. Thank you, Kuldeep. We will be sharing the recorded link to all the participants. This concludes the call. Thank you.